Hello, I'm Lelda Smits for the Finance News Network, and joining me from investment bank UBS is its chief economist, Scott Haslem. Scott, welcome back to FNN.
Thank you.
When we last spoke a year ago, you said UBS was overweight Australian equities. How has your exposure changed since?
Well, after a very good year and a global economy that's starting to look moderately better, we now think Australia is a little bit of an underweight in an Asian context and in a global context. We still think you'll see the market go higher here, but we're not expecting as much performance from Australia as we might expect in some of the other markets offshore.
The S&P ASX 200 index jumped 15% over last year. What's your forecast for the benchmark index this year?
We're looking for the ASX to get towards about 5,700. So that's capital growth of around 7.5% from where we are. So that's a little less than we've seen in previous years, but certainly a reasonable performance.
In your view, which sectors have performed well and where are you seeing future growth?
Well, our equity strategists are looking to be a little bit overweight the mining sector and a little bit underweight in the banking area. We have a tilt towards the domestic part of our economy where we think lower interest rates are having quite a positive impact on the housing impacted parts of our economy. We also like GARPI type stocks, so growth at a reasonable price, particularly healthcare and those sorts of areas in the domestic economy.
Now, the mining sector has come off steeply as commodity prices continue to stumble, but you say UBS is overweight miners. Why is that?
Well, we have a moderate view on China in the sense that we think it is slowing, but not tremendously. So growth around 7 to 7.5 over the coming couple of years. Within that, we also think that China is becoming less commodity intensive. So that is going to have some downward pressure on commodity prices relative to where they've been over the last few years. But despite that, we think valuations are very attractive. In mining, our strategists think the market will eventually start to value the free cash flow that you're going to see from the mining companies as they return capital to investors and maintain a fairly subdued capex outlook.
And Scott, is there anything in particular that's looking attractive to you, grabbing your attention, or looking particularly undervalued?
No, we like the big miners because we think you get diversification there without the risks associated with some of the smaller single stock commodities.
Now, to the commodities in more detail, the price of gold plunged almost 30% last year. Are you bullish or bearish about this safe haven asset?
Well, gold is, at least for an economist, gold is an asset class of extremes. It's something you want to own if you think the world is booming and you want an inflation hedge. It's something you want to own if you think the global economy is going through a very difficult financial crisis and governments are debasing currencies. Neither of those seems to be the environment we see going forward, so we're not particularly excited about gold.
And Scott, overall, which commodities do you believe are positioned for the biggest price gains or falls?
Well, overall, the commodity complex we think is probably coming down in the terms of we think the commodity boom is over. We think generally commodity prices are going to drift lower over the next couple of years. Our commodity strategists do think iron ore has the potential to pick up quite a bit through the second quarter of this year. That's a typical seasonal restocking period for iron ore. They're looking for the iron ore price, which is now down at 110, to maybe get up as high as 130, 140 through the second quarter. But the general feel on commodities we think is one of moderating commodity prices.
So how does your outlook for the mining sector compare to the energy sector?
We are also quite upbeat on the energy sector. We think that project delivery there is quite good. So there's a number of companies within the energy sector which we think will do quite well.
Finally, Scott, what are the key risks to Australia's economic prospects that you'll be keeping an eye out on this year?
Well, I think in the short term, if we're talking about this year, I think most of those rest either in China or in terms of global political /war type events. I think they're the things that potentially could lead us to look back at the end of this year and find that we haven't quite met our targets in terms of risk assets. So China is particularly one of things slowing down a little bit more than anticipated, or having more problems in the shadow banking or the NPL environment than we're anticipating. Those type of risks we don't think are going to lead to global systemic problems. but they may well hamper the market's ability to move materially forward.
Scott Haslem, thank you so much for your outlook today.
Thank you.